But let's dig into what we're seeing today, what Jared was just saying, whether or not this rally is going to continue. For that, we have Julian Bridgen. He's MI2 Partners co-founder and president. Julian, it's good to see you. Jared was just talking about whether or not the gains that we saw this week, if there's enough momentum to continue over the coming weeks. What do you think?
I'm a bit skeptical, I've got to be honest. I think it was interesting that you pointed out crypto. I've been watching crypto very carefully. The correlation to the equity market has been very close in the last few weeks. That is actually trading very, very poorly. There's some very big levels. So if you look at Ethereum, you would not want us to break through sort of 17,000 on the downside. That's held us for many, many months. And it looks to be probing that level on the close. Bitcoin around the 28,700 level is the same sort of level. And that makes me think a little bit that what we're seeing in the equity market is really month-end rebalancing after a very, very poor equity market, which I think has resulted from, people having to rebalance their portfolios and buy some equities. If it continues past midweek, let's wait and see. And I'll give it some credence then. But I got a sell signal for my S&P model. I think I said when I was last on the show, I was about to get one. And that we'd have to go quite a long way to start negating that. So I'm still in this, this is a rally in a bear market mode.
Are you seeing at least the inflation number beginning to peak, especially given the earlier print today?
Well, if you believe the professionals, it's been peaking since last January. The professionals have got it consistently wrong. The economists have got it consistently wrong. I think there's a good chance. Look, as they say, a broken clock is right once a day. I think there's a good chance that we're starting to see some signs of flatlining, but I think there's an awful lot of pressure still in the system. And I think if we start to see inflation pressures start to abate, there's two concerns I've got. The first one is, because there's so much price pressure still in the system, in producer prices in particular, if they don't pass it on, that would imply to me margin compression, and that isn't good for the equity market. And I think the second thing that the equity market needs to understand is the Fed has made it very, very clear. In fact, if you go and listen to the interview that Powell did, was it last weekend or the weekend before, on NPR, and he talked explicitly about the need to right size the labor market and to reduce the demand for labor. That can only be done, and this is one thing I talked about quite extensively on the last interview that we did, by tightening broad financial conditions. And the problem is that's extraordinarily hard, nigh impossible to do, unless you get the equity market down and the equity market stays down. So ironically, the more that the equity market tries to fight this, the more that the Fed will probably have to fight them.
And I wanted to shift gears here and talk about earnings. Obviously, we've seen margins being pressured a lot. Do you expect that to continue? Are we anywhere near perhaps seeing some relief on that side?
No, I really don't. I think it varies from industry to industry. I think, if you go back and you look at the late 1960s, for example, which was the first time that we had a big pickup in inflation, this a structural pickup that I think we're now, you really started to differentiate the winners and the losers on the pricing power side. And I think we've started to see that. I mean, retail, which we saw obviously with people like Target and Walmart, are classic areas where they have very, very little pricing power because it's an incredibly competitive marketplace. So I think when I look at our margin models, they're appalling. They're down at levels that we haven't seen since the global financial crisis or the dot-com bubble bust. The only thing that is stopping that happening is that companies are passing the price increases through. But that means inflation. And conversely, those that can't pass it through could see enormous compression in margins. So I think this becomes increasingly a split race between the haves and the haves not in terms of pricing power.
So, Julian, I guess people who are trying to figure out how to adjust their portfolios right now, there's so much uncertainty. A lot of it relies on the Fed. We take a look at that inflation number, seems to at least be heading, I guess, slightly in the right direction, but still obviously historically extremely high. What should people be doing right now?
So, since November, I've been building cash. I've been bearish. It's been very difficult. I haven't built enough cash and I'm a bear. So that just tells you, how hard it is. I think the thing that I'm really thinking about longer term is that I think that the US has had a decade of a fantastic run where we've seen these tech stocks dominate the trends for the last decade, enormous outperformance of the US versus its peers overseas. And I actually think those days are gone. I think we are moving back into the sort of period we saw from 2002 to 2008, when we saw a steady dollar decline, where we saw US equities underperform the rest of the world and underperform hard assets. So on any weakness, I'm trying to allocate into the rest of the world and into those tangible overseas, those tangible assets. So some commodities, some precious metals, and also those countries that tend to benefit in those sorts of environments, so the likes of Brazil, Canada, New Zealand, Australia, South Africa. So that's really how I'm managing my portfolio. And I think I've said to clients, I think we're on the cusp of a rotation of biblical proportions, where the first become last, and the first is the US, and the last, which is emerging markets, commodities, become first. And I think over the next decade, that's where the real money is to be made. And I'm afraid it's outside the US, which is what a lot of people own.
All right, Julian, it's a Friday of a holiday weekend. The Dow snapped an 8-week losing streak, the NASDAQ 7. I'm going to force you out of your comfort zone, giving an economic indicator or a sector you do feel positive about.
So I think I do think that this market maybe has a little bit more, but not much. We'll see next week. As I said, price action beyond Tuesday, which is month-end close, I think is going to be critical. I still really like the minings and metal sector. I think that's a great sector longer term. It is still actually one of the few sectors, if you look from when the dollar started to rally in 2011, which is when this real US equity market started to outperform, is still negative in absolute terms. That, to me, is where the longer term opportunities rise. It's a little choppy at the moment, but whenever you get nervous, I would sell some S&P or NASDAQ against that. I really think that is one that could be a 7 or an 8 bagger over the next few years.
That is a glimmer of sunshine. Julian Bridgen, MI2 Partners co-founder and president. Thank you, sir. Enjoy the holiday weekend.